Hi, I'm Karen Ziska with Neighborhood Loans. Thank you so much for joining today's webinar. During this webinar, I want to let you know that I'm going to give you all the information you need to empower you to make the best decisions as a home buyer. I'm not going to sell you anything. I'm not going to pitch anything to you. I am going to give you all the information that you need. And when you're ready to purchase, feel free to reach out to me. My team would love to help you with your financing needs. Should you have any questions, feel free to also reach out. My contact information will be in the webinar. Good luck and thanks again for joining.
Okay, so let's get on with the content. Okay, first-time home buyers and don't make these costly mistakes. So as a first-time home buyer, do you feel stressed out, intimidated by the process, anxious, or uncertain? I completely understand. We'll get all of your questions answered and empower you to be able to go out and confidently start the process and negotiate an offer for a house. So let's start with first-time home buyer. What is a first-time home buyer? A first-time home buyer is someone that meets one of the following criteria. Either you've had no prior ownership or you have not owned a primary residence in the past 3 years. A primary resident means that you're going to live in the property. So what are the key steps to home ownership success? How do you go about buying a house? First, you want to get a pre-approval or a fast-track approval, hopefully with my team. Here's the link to register to schedule an appointment. So next, after you pre-approved and you know your numbers and you're confident with those numbers, you're going to go out and find a realtor. If you need one, let me know. I have referrals in your area. You're going to sign a buyer agency agreement. Now, this is a National Association of Realtors requirement as of 2024. Then you're going to go out and you're going to house hunt with your realtor. You're going to offer and negotiate on a property. And then once you come to terms, you're going to execute the contract. Depending on your state, you will have an attorney review period. There's a home inspection and or condo review inspection period, also depending on the property that you're buying. Once you go through the complete loan process, the lender will issue you what's called a loan commitment. Once you get that loan commitment, that means they're going to lend, they'll schedule closing, and you will do your final walkthrough. You go and close at a title company, which means you're going to execute all the loan documents saying you are taking on the financial responsibility of that property. And then you move in and you throw your housewarming party. Sounds simple, right? It is. Now, let's look at the mistakes that you could be making if you decide to continue to rent because it's less costly up front. So the cost of continuing to rent versus buy can be up and over $295,000 that it's costing you. Let's look at how homeownership enables you to build wealth. According to a study from 2022, the average median net worth of a homeowner is $396,000, where the median net worth of a renter is $10,400. This shows the huge difference between wealth accumulation of the two groups. Homeowners show 40 times greater net worth than renters. When you own a home, you're going to be able to take advantage of the equity that you're building every single month through your mortgage payments. Your home is also going to continue to appreciate in value over time. You get tax write-offs, and you do get equity in the property as stated before. So let's look at a path to building wealth and owning a property. When you own a property, you have asset diversification. So real estate is a tangible asset, and it helps to reduce your reliance on stocks and bonds alone. And then it will hedge against inflation. Everybody has seen their rent going up dramatically over the past couple of years. When you buy a home, ideally you're going to buy it with a fixed rate loan. So your principal and interest payment for your house will stay the same. The only thing that's going to fluctuate over time are your taxes and insurance. So this is going to give you a stable housing cost where you will not have large swings in your monthly obligations like you do in rent that can increase annually. It creates generational wealth. So you are able to take your asset and give it to a family member in your passing. Also, as you are gaining equity, you're able to borrow against that property and use that money down the line for something in the future, like a child's education or a wedding or something like that. So it's a forced savings mechanism where your payment effectively is acting as a savings plan because every month you're paying down your principal and your home is appreciating. So let's look at how much rent is costing you. If you keep renting at $2,800 a month in 3 years, that's $100,800 that you've paid to your landlord. In 5 years, it's $168,000 paid to your landlord. 10 years, $336,000. You have no equity, no appreciation, and no tax benefits. But your landlord thanks you because they took advantage of all of those. So let's look at what does $2,800 buy you? So if you take a mortgage payment with a principal and interest payment of $1,930, property taxes at $600, homeowner insurance at $160, mortgage insurance at $110, your total monthly housing cost is $2,800. So using a 6% interest rate, because that's kind of what rates are right now, your approximate loan amount is $320,000. So let's look at what the long-term difference is. With a 3% appreciation after 10 years, that same home is worth $430,000, which is about $110,000 in appreciation alone. Now, over those 10 years, you've also paid down your principal, so you have additional equity in that property. Rent over those 10 years costs you $336,000. Home ownership allows you to build equity and gain appreciation. A mortgage is an investment in your future, and the key is knowing your true payment, not just your approval amount, because you want to buy when the numbers make sense for yourself. You don't want to just buy because you feel like you have to. So let's look at your financing options. So not all lenders are created equal. Mortgage bankers provide access to the most programs. Large banks may not offer all programs. So some of the programs that they may not offer are FHA, non-QM, down payment assistance, or some lenders or some banks don't offer VA or USDA. So banks and credit unions' core business is to grow deposits, mark up and lend at a premium. Large banks typically have stricter guidelines. They want to stay within their lending box. In a large bank, remember, you're one of 1,000 clients. They're focused on deposits. Let's look at types of mortgages. So there's conventional and conventional renovation. Many people don't realize that conventional loans also have a renovation loan. Most people will automatically think of a 203K, which is an FHA renovation, but there is conventional also. So FHA and the FHA renovation loan, VA and VA renovation, USDA, and there are more creative loans that are called non-qualified mortgages or non-QM. Loans like a DSCR, self-employed, bank statements, 1099 loans, and investor loans. So let's look at where do loans come from. While lenders lend you the money to buy the house, the following organizations back the loans and put liquidity back into the market: Freddie Mac, Fannie Mae, FHA, VA, and USDA. So let's understand down payments. How much money do you actually need to buy a house? There is a conventional community lending program where you can put as little as 3% down. There's also a 3% down option that is not a community lending product. There's a 5% conventional. Now, were you thinking, really? I thought I needed 20%. It's a misconception. No, you don't need 20% for a conventional loan. For renovation loans, for conventional, it's 3 to 5%. For FHA, it's 3.5% down. For FHA renovation, it's 3.5% down. VA is 0% down. USDA is 0% down. And non-qualified mortgage, some of them go as low as 10% down. And investor DSCR is 20%. Now, while there are no down payments for some of these, there are still closing costs. Keep that in mind. So let's look at some of the different loan types and get some information about them. An FHA loan is insured by the Federal Housing Administration. It's designed to help people, especially first-time homebuyers, qualify for mortgages with more flexible lending requirements. Here are some of the benefits of an FHA loan. Low down payment of 3.5% with a 580 credit score. FHA loans are available for people that have credit scores as low as 500 with 10% down. They're easy to refinance with an FHA streamline. So here's an example. Let's say somebody were to buy a home when interest rates were at 7 or 8%, then they fall to 6. You are able to do an FHA streamline with very limited paperwork. Basically, the lender needs to show that you've made 12 months of mortgage payments. You show your ID, and that's all you need. So a streamline is great when it comes to having to refinance, because remember, you're marrying the house, not the interest rate. FHA typically has low mortgage rates. They do allow a higher debt to income ratio, and you could choose between a 15 to 30-year fixed rate or adjustable term. Down payment assistance and grants are accepted. Seller can pay closing costs up to 6% with a seller credit. So let's look at an example with dollars of how much do you actually need. So let's say Anita wants to buy a house at $300,000. Her minimum down payment, the 3.5%, is $10,500. Her estimated closing costs are $9,000. So that $9,000 is on top of the 3.5. That's going to be for items like your first year of homeowners insurance, any lender fees, discount points, your tax escrow, your insurance escrow, and title fees. So total, you're looking at $19,500 that you would need to bring to closing. So instead of bringing $19,500 to closing, what can you do? So you can ask for a seller credit. You can get up to 6%. So let's say you're able to negotiate $9,000 off. And then you're able to get a gift of $5,000. The total you need to bring to closing is $5,500. Now you can get, if you don't have a gift available, you can get down payment assistance depending on the area that you're buying in. So let's look at a conventional loan. A conventional loan is not offered or secured by a government entity like FHA. It's available or guaranteed by private lenders or private companies. Those two are Fannie Mae and Freddie Mac. So now let's look at down payment assistance. Down payment assistance is available in most areas. Typically, they do have higher interest rates. No money is free. They may have higher points that you have to pay. They likely will have a credit score requirement, and they will have a debt to income requirement. And there will likely be income limits, and they likely have to be paid back in full or on a monthly basis. They do have housing price limits. And when you move in day one, you have negative equity, which means you owe more than what the house is worth. However, as it appreciates, then you will get into an equity position depending on how much down payment assistance that you obtained. Now let's look at the difference of what is a grant. A grant is financial assistance provided by a local government for home buyers. It's typically targeted to first-time homebuyers or specific communities. It can cover down payments, closing costs, or home repairs. It may not include covering your real estate commission. You will need to check with a specific grant that you would be applying for. And eligibility may depend on income, location, or other factors, and grants typically do not need to be repaid. They likely have a minimum time period that you have to live in your home. Some are up to 10 years. So let's look at mortgage insurance versus property insurance. Mortgage insurance is there to protect the lender in the event of default. Typically, if a loan has less than 20% equity for a conventional loan, then you're going to require to pay mortgage insurance. If you make your normal ongoing payments, it will take 10 years typically to get 20% equity. With an FHA loan, mortgage insurance stays for the life of the loan as long as you put down less than 20%. And VA and USDA do not have typical mortgage insurance. Property insurance, on the other hand, that is designed to protect the homeowner and their property. So it covers damage to your home. So something like a fire, a flood, a tree falling on it, that's what homeowners insurance covers. And you will want to discuss with your insurance agent the different types and amounts of insurance that's available for your property. There's many different additions and riders that you can add, and the amount of coverage is going to depend on what the lender is going to require, along with how much additional coverage that you're asking for. So let's look at a side-by-side comparison difference of FHA versus conventional. FHA, 3.5% down, conventional, 3 to 5%. Minimum credit score for FHA for that 3.5% is 580. For conventional with Freddie Mac, it's 620. However, Fannie Mae evaluates borrowers' full financial picture. They're going to look at things like proof of rent and on-time rent payments for the last for the last 12, 24 months. They're also going to look at on-time borrowing as far as on-time payments of credit cards and cars. They're also going to look at utilization of credit cards. So they take a holistic approach looking at an individual's repayment history and borrowing history. Maximum debt to income ratio. Your total debt to income ratio for FHA is 56.99%, and with conventional it's 50. Now, how do we calculate a debt to income ratio? We look at your gross monthly income, and then we look at what are all of your debts, including the new house that you're buying. And we're looking at your minimum credit card payments, your car payment, and your student loan payment. If your student loans are in deferment, we still need to use a calculation to calculate what your payment would be in the event that you have to make a payment. So for an FHA loan, for the student loans, we're looking at 0.5% of the unpaid balance. For conventional, we're looking at 1% of the unpaid balance. Now, if you're on a repayment plan, we're looking at what your obligated repayment plan is. And if you're on a tax repayment plan, we need to include that in your debt ratio also. So what you do is you add up all of your debts, and you take that and divide that by your gross monthly income. So that's your income before any deductions. And whatever percentage that is the number that calculates your debt ratio. Now, there's a housing ratio also, but we're just talking about total debt ratio right now. So let's look at loan limits. Oh, I apologize. My these are the 2026 loan limits, but my slide, I didn't update the 2024 part. So for a single family home for 2026, FHA minimum or maximum loan amount is 541,287. For a 2-unit property, you're at 693. A 3-unit, you're at 837. And for a 4-unit, you're a little over $1 million. For a conventional loan, a single family maximum loan amount 832,750. For a 2-unit, 1,066,000. 3-unit, 1.2 million, and for a 4-unit, 1.6 million. And minimum required investment for FHA for a single family or up to a 4-unit is 3.5%. That's why a lot of people use FHA loans for house hacking, where you're going to buy a multifamily property, live in one unit, and rent out another. With a conventional loan, depending on the type of property, it's 3.5% to 5%. So let's look at what can you use for down payment and closing costs. We get this question all the time as a lender. Can I use the money in my 401k or a retirement account? Yes, you can. Can I sell personal property like a car? I've had people sell goats, motorcycles, boats, jewelry. Yes, you can. We're going to need a sales receipt because we will need to look up the value of that asset and make sure that you sold it for a reasonable amount of money. A gift from an immediate family member? Yes. Savings in the bank, stocks, bonds? Yes, we can use all of that for your down payment and closing cost. A loan from your credit card or a cash advance from a credit card? No. A loan? Yes, you can use a loan as long as it's secured by collateral. So let's say your car is paid off and you want to go and finance your car and get a loan against it, as long as we show the paperwork and it's secured by collateral. You can get a second loan on the house, which a lot of down payment assistance programs are. Then we can use that for your down payment and closing costs. Cash at home or cash in your drawer? Typically, the answer is no. Don't go and deposit large amounts of cash into the drawer or into the bank from your drawer. Have a conversation with your lender beforehand because they are going to need to know where that money came from. A friend's account who's not on the loan with you? No. Even if you are having money deposited or sent to your friend's account who's living with you, if you're not on that account, you cannot use their money. So first-time home buyers, I specialize in working with first-time home buyers. I try and spend a lot of time educating them throughout the process and answering all questions. So if you have a question, feel free to reach out. I'm happy to answer it for you. So when it comes to buying, you're going to deal with your loan officer. However, there's a full team of people behind that loan officer that are getting you from start to finish. So during the process, the loan officer is going to ask you for some documentation and some paperwork. But the rest of the people that are on the team may need additional information. So don't be surprised if somebody asks you for more paperwork or different paperwork than what was provided. So of course, I'm here in the red jacket. Rachel, who works with me directly, is also a licensed loan officer and available to answer questions. So I started in the business in 2001. I've helped over 10,000 people move into homes, either through my real estate career or financing or as an asset manager. So throughout the process, there's a disclosure team, a processing team, underwriting, a lock team, quality control, closing, funding, and post-closing. So you could see it's a big endeavor getting somebody from start to finish. So let's look at the mistake of not getting a pre-approval. So many times people will come to me and say, I really want to buy, but I'm afraid of the hard inquiry and it's going to hurt your credit score, hurt my credit score. A hard inquiry is typically about 5 points, and the impact is short term. While you make your payments next month, your score will go back up. If you have multiple hard inquiries in a short time period, you can expect that your credit score won't necessarily go down if you're in the same industry. So let's say you're shopping for a couple of different lenders and you didn't like the customer service, so you went to somebody else. You're not going to see a huge drop in your credit. Where you will see an impact is, let's say you maxed out your credit cards, then you went shopping for a car, and then you decided, no, I don't want a car. I'm going to apply for a mortgage. You have a bunch of stuff in going on with a bunch of different industries. That's when the algorithm is going to drop your score. So let's look at what does credit scores mean? So based on the FICO credit model, your scoring will range between 850 and honestly, it will go down to 0. So as a lender, we're looking again for an FHA loan, we're looking at 580. So that's down here at the bottom. So the higher you go, the lower typically your interest rate is and the lower your points are. So when it comes to lending, lender is going to order what's called a tri-merged credit report, which combines the credit scores from the three major credit bureaus, Experian, TransUnion, and Equifax. And as the lender, what we do is we throw out the high score, we throw out the low score, and we use whatever that middle score is. And when you have your credit run by a lender, you want to make sure that you look at your credit alert when it comes across. You may get 3 alerts that your credit was pulled. It does not mean it was pulled 3 times. You're getting an alert for each credit bureau. So when applying for a mortgage, lenders typically will use a FICO score. So a FICO score looks at their scoring model is created and used for versions that were looking at credit risk for long-term loans like a mortgage. Now, on the contrast, a Vantage score is typically what you will see when you pull up your bank app and it tells you your credit score or Credit Karma. That score is generally for shorter lending or borrowing credit. So things like cars and credit cards. Now, some lenders can use a Vantage score when it comes to mortgages. However, most are still using FICO scores. So let's look at how does your credit actually get calculated? 35% of your credit is based on your payment history. So many times people come to me and they say, oh, well, my score is low because I have inquiries. No, it's not. Either your payment history is not stellar or your utilization is too high. So when you look at utilization, you're not necessarily looking at your total utilization of every debt you have. Each card carries its own weight. So if you have a bunch of credit cards that are, let's say, $300 limits and they're maxed out or over, you're going to see your credit score is lower. You want to use your credit effectively. Keep your credit card balances ideally below 30% of the limit. Once you go over 50% of the limit, it starts hurting you and taking points away. 15% of your score is the length of time that you have had that line of credit open. 10% is the diversification of the types of credit you have. And only 10% of your score is actually the inquiries. So removing inquiries, yes, it helps, but you can see it's a very small portion of your total cumulative credit score. So when it comes to applying for a loan, don't be afraid to do it. It's actually easy. So a loan consultation will help you to determine how much you can actually afford to spend on a home based on 3 factors. First is your credit, which again is that tri-merged credit report that we talked about. Your income. We're looking at 2 years of income that's needed to be documented. So people have the misconception that you have to be on your same job for 2 years. We have to show 2 years of work history, and you need to have consistency in the field that you're in. So when looking at it, of calculating your income, we're going to look at 2 years of income, and we're going to look at your current income. If you have overtime, we're going to take a 2-year average of that overtime, unless we get a letter from your employer stating you're guaranteed X amount of hours. Commission or tips are also averaged over a 2-year period. And you want to make sure that if you are working full-time and employed to work full-time, that you're actually working full-time hours. We're also going to look at your assets. How much money do you have, and what's your ability to close on the loan and make your expected payments. So we're going to review the numbers before you view a house, because we want to make sure, what do you actually qualify for? And when you know what you qualify for, it's going to increase your bargaining power, because you're going to be able to choose the correct type of approval and down payment assistance or a grant if needed. You will know what your monthly payment is and what your total investment or cash to close is for that particular property. And you're going to identify which loan product will fulfill your needs. So if you can qualify for an FHA loan and a conventional loan, we're going to go through the numbers for both of them with you, so you can pick which loan that you want to use and go over the pros and cons with you. So you're going into that negotiating process with the full knowledge and empowering you to make the best decision for you. So let's look at the different types of loan approvals. You have a pre-qualification, which is good. You have a pre-approval, which is better. And then you have a fast track approval, which is best. Now let's break those down and go over each of them. So a pre-qualification, it's a verbal approval or a estimate of qualification. Credit can be run or it can be verbally provided. Automated underwriting is not necessarily run for a pre-qualification. A buyer verbally will provide their income, down payment amount. This is the lowest form of qualifications. Most sellers and their agents will not accept this type of qualification because nothing has been validated, nothing has been viewed, and it's kind of taking your word for everything. Now, a pre-approval, automated underwriting is run. The loan officer has viewed your income, your pay stubs, and the documentation that's needed has been reviewed. Your credit has been reviewed by the loan officer. The down payment has been sourced and documented, and so bank statements have been reviewed or investment accounts. Many buyers use this type of approval when submitting an offer. Now, a fast track approval, that is your strongest approval when it comes to making an offer and negotiating. This type of approval, your loan is reviewed by an underwriter. The underwriter issues a mortgage commitment subject to appraisal and title. So we have, and your underwriter has reviewed the income, your credit, your assets, and issued you a promise to lend. This is a faster way to close. So with a pre-approval, you're looking at about 30 days to close. If you have a fast track approval, you're looking at about 10 to 14 days to close. So this is the strongest type of approval. This gives the seller confidence to accept your offer And if you're in a multiple offer situation and you're going up against somebody that has a pre-approval and going to take 30 days to close, or a fast track approval with 10 days and only subject to an appraisal, most sellers are going to pick this option. So let's look at what does an underwriter actually do. So when you get qualified, your loan officer is going to ask you for documentation. They're going to ask you for your last 2 pay stubs, last 2 bank statements, last 2 W-2s, and your ID. Now, the underwriter is going to review all of those documents. They will, and most likely will ask for more documentation based on what they're seeing on what has been provided. So let's talk about capacity. Capacity is you as the borrower's ability to repay the loan. So the underwriter is going to scrutinize your credit. They're going to look at your employment history, your savings, your monthly debts, and other obligations to determine if you can financially and comfortably take on this loan. So they're going to look at your debt to income ratio and see, are you able to add a new debt and comfortably make those payments? They're going to look at capital. Capital is how much money you have in the available assets and the likelihood of repayment of the loan. Because remember, we as the lender are lending you the money to buy the house. We expect to be paid back, so we have to show that you can pay that money back. Character. We're going to look at your character as far as your bankruptcy history. Have you, taken out debt and not paid it and filed bankruptcy? Let's look at your total credit record, your job stability, any education, experience, earning potential, and residence stability. So all of that takes into consideration when you're buying a home. And we're going to evaluate the collateral for the home loan, and the collateral is the house that, that you're buying. So through an appraisal, we're going to look at the property's market value and make sure the amount that you're offering on the home supports the loan amount. We're going to look at the condition of the property. We're going to make sure that the property is acceptable condition and doesn't have significant issues. We're going to look at the property type. So different property types have different risks affecting the loan terms. We're going to do a title search. We're going to make sure that the property has clear title with no liens or claims that could just jeopardize the lender's rights. Location. We're going to make sure that the property is located in an area that makes that doesn't have anything undesirable near it or influencing risk for the lender. So these factors, all of them combined, help underwriters determine whether the collateral is sufficient to secure the loan and protect the lender's investment. So let's go through do's and don'ts while you're shopping for a house. Schedule a loan consultation first and foremost, whether it's with me or anybody else. So there's the link to meet with me. And then call if you have any questions. Continue living at your current residence. Continue paying your mortgage or your rent. Continue using credit as normal. Keep working at your current employer. Keep your same insurance company. And stay current on all existing accounts. Expect requests for additional documentation throughout the process. Don't make any large purchases. Do not go out and buy furniture while shopping for a home. Don't charge anything. Don't change bank accounts or make any large cash deposits. Do not transfer balances. If you transfer balances from one account to another, we're going to need more documentation. Do not close any credit cards. Do not open any credit cards. Don't consolidate debt onto one credit card. Don't apply for new credit or take out a loan or co-sign on a loan. Do not change or quit your job. If you do change or quit your job, tell us immediately because we will find out. Do not max out or overcharge on your credit cards. And do not pay any collections without talking to your loan officer. So now let's look at the mistake of not working with a buyer's agent and calling the list agent directly off of a sign or off of the internet. So why should you work with a buyer's agent? Using a buyer's agent has several benefits that will make the process smoother, more efficient, and ultimately more successful and less stressful for you. They have expert guidance and market knowledge. They have access to listings. So if you are looking primarily on Zillow, Redfin, Realtor.com, you are not getting all of the listings in the area. There are private MLSs that are available that agents take advantage of and make sure that they have access to all of the listings. They're also strong negotiators. You are emotional when it comes to buying a house. Your realtor negotiates on these type of transactions day in and day out. They are experts when it comes to negotiating. They can give you objective advice about the house, about the offer, about the market itself. They handle paperwork and legalities, and in some areas they will refer a attorney, and they have connections to professionals like home inspectors, attorneys, radon inspectors, all the people that you need throughout the process. Realtors save time and stress. They save you money. And they are an advocate in a complex situation. And they will also help you when considering future resale considerations. Now, overall, using a buyer's agent ensures that you have a knowledgeable ally on your side. They work to protect your interest, guide you through the complexities of purchasing a home. Now, in 2024, the National Association of Realtors mandated that there was increased transparency in the real estate commission disclosures. So now, prior to a realtor taking you out to look at homes, you will sign a buyer agency agreement that will explain how much that buyer agency or buyer agent is getting paid. So they can go to the seller and ask the seller to pay that commission, or it becomes your obligation to pay it. When you are getting pre-approved with me or anybody else, we will factor your cash to close without commission because it's at the beginning of the process. Once you sign a commission agreement, circle back with your lender so they can tell you exactly how much commission that you will need to bring to closing in addition to the down payment and closing cost. Now, in a lot of cases, the seller is still paying that commission and it's no additional money out of your pocket, but you need to know those numbers to start with because it may be as little as like a quarter or 0.5%, but there might be a number that you have to bring to closing. You need to know that number. So understand your buyer agency agreement. Make sure that you actually read it. Pay attention to the sections that detail how the agent will be compensated. It's tied to the commission that they will be paid when you close on your home. So review the commission obligations with your lender once you sign it. And look for flexibility in the agreement. Most of them do have a flexible period of time, or you can negotiate that time period. So flexibility is your right. Don't feel pressured to sign a long-term agreement if you're not comfortable. So let's look at skipping a home inspection when you're under contract. The cost of a home inspection is about $450. The cost of skipping a home inspection could cost you over $20,000. So when skipping a home inspection, when you buy a house, you are unaware of deal breakers like structural issues, electrical issues, plumbing, and other health and safety issues. So you risk inheriting non-structural safety issues like mold, radon, carbon monoxide. You miss having a forecast of future repairs. So a home inspector will go through the house and tell you exactly what repairs are going to be needed in the future and what health and safety items exist today. When you skip having a home inspection, you lose your negotiating power. Home inspector will help you also establish a list of items that you could be including in a renovation loan. So let's recap what we learned today. Know your financing options from the beginning. Get approved from the start. And you want to get approved before looking at any homes because let's say you start looking at $400,000 homes and you're only qualified to 300. You fell in love with a, five, six, $400,000 ones. A $300,000 one will never make you happy. So you want to make sure that you're looking in your price range and looking in the condition range that your loan needs to be in. So don't just go to a bank for your mortgage, explore your options. Don't skip having an agent represent you. Even when you buy new construction, you want a real estate agent advocate on your side. Don't skip a home inspection. Biggest mistake, as we saw financially, continuing to rent versus buy. Now, you've seen that this process isn't hard, it's not complicated. And when you break it down into the steps of getting qualified, then going out with it, finding an agent, going out and looking, it's a very easy process. And you want to start the process sooner than later because you want to know exactly, does your employment fit with the guidelines and requirements? Are you working the right amount of hours? If you're a construction worker and you get unemployment and you work during the season, how much are you actually qualified for? If you're a truck driver, paid mileage, how much are you qualified for? So those are things that we'll go over in the loan consultation. Know those numbers ahead of time and then know the budget. How much money do you need for closing and what does your monthly payment look like? So I'm confident using these tips will give you a significant advantage when buying a home. Hopefully now you feel confident in being able to purchase a home. So reach out to me should you have any further questions or if you want to see what you qualify for or to get your fast track approval. Mention this webinar at time of application. You will receive a $500 lender credit when you close with me. Again, to schedule an appointment, please use this link and schedule an appointment. I'm here to answer any questions that you may have. Thanks again for joining, and I hope you make it a great day. Bye, everyone.